Good evening, dear guests, dear members of CFA Association Russia, and dear participants of our former macro events. We, as usually, go on with our monthly update in the last decade of each month. The only exception is the end of December, when we hold our annual event, which is an outlook for the next year and some conclusions based on the years that is finishing. So again, our main presenter today is Andreas Bickel, CIO at Blackfort Capital, a Zurich-based portfolio asset management company. And our moderator today is Maxim Matveyev, CEO of Atera Capital, Moscow-based asset management company, and he's also a board member of CFA Association Russia. So good evening, Maxim, and please introduce the event and our main speaker.
Vladimir, thank you for the introduction. 2021 was by no means a quiet and peaceful year, yet high return and low realized volatility has generated a risk-adjusted return that was one of the highest over the last century on the US market. Year-to-date, S&P 500 has returned 22%, and the risk-adjusted return was 1.7. Bitcoin, over the same period since the start of the year, has soared more than 60%. But on a risk-adjusted return of 0.8, it was just one half of that of US market. As investors are turning to the new year, there is still plenty of macro risks and uncertainty. So let's discuss the outlook for 2022 with Dr. Andreas Bickel. He has more than 25 years of experience in asset management as head of portfolio management in Goldman Sachs, Clarendon, Rothschild Bank, and Blackfort Capital. I invite all the participants of our webinar to submit questions throughout the presentation in the chat, and we will address them at the end of the presentation. Andreas, please go ahead.
Thank you. Welcome from Zurich. As you can see, the background is different to last time. So we have, like many other places in the world, hit by a new wave. This time the virus is called Omicron. The last one was Delta. And this has impacted my presentation and my outlook. So let me share with you my screen. The title is unchanged. So I still believe that next year we will have solid growth globally. But the risks have, since I have written the title, massively increased. So we will go, as usual, through macro. We will go a bit against my inner will because I'm not a virologist by all means, but we will go through the economic impact of Omicron. We have to address inflation. This week on Thursday, we will see the PCE deflator of the US, which is expected to hit a new record level in this cycle. Revisiting the theme of a 60-40 portfolio, why you might consider holding government bonds, knowing that the return of it is by the start a negative one. However, they might serve you for certain purposes. And then basically, I'm going to talk about the outlook, and I might touch a little bit on gold, commodities, FX, and cryptocurrencies. With that, let me start. This was supposed to be the key message for the macro environment. So some days ago, this is not old, really not old. The narrative you could read all around is that the economic news are surprising. I would add, are they really, question mark? Because if you were here 1 month ago or in one of the previous sessions, you know that I come from the angle of an asset allocator, and I look at this from PMI data, where the correlation, at least in the US, with the stock market is pretty high. And that picture was crystal clear. We will see an acceleration of growth and a positive outlook for equities. And until we had the recent turbulences, that is and was the key message. And now the question obviously is, how does it go on? How will it continue? A lot is unknown, and everything you will see is based on models, on quant tools, and they depend on data. And data obviously is not yet fully available regarding the impact of Omicron. But let's have a look what the data tell us. So if we go to the US ISM manufacturing, you see the white line, that's the one I presented last time, and the blue one. The blue one is basically a regression of regional PMI data, which are more frequently available. The key takeaway is probably by the beginning of January, the PMI data will drop below 60, but stay above 55. Well, what does that mean? It means basically above 55, there is an acceleration of the economy. So the impact will be here, definitely, but for the US, it is expected that the impact will be minor. For the global area, they did the same analysis. This was macro bonds. The chart is a bit different to the one before, but basically it shows you the expected changes in index point by the next release of the JP Morgan global PMI data. And if I'm rounding up, I would say that probably we are going to see the index dropping by 2 points. This, however, would mean we stay above 50, not 55 like in the US, but above 50. And above 50 still means that the global economy is expected to grow over the next 12 to 18 months. So also here, yes, there is an expected impact of the Omicron variant on global growth, but it doesn't look like a recession. Today, I came across another metrics from Bloomberg. Basically, they do nowcasts. And the nowcasts here, you see the quarter over quarter change on the left-hand side. And for the US, the impact is even slightly positive if you compare November to December. In the euro area, slightly negative, and so forth. So if you believe in nowcasting, also from that angle, again, a toolbox underneath is written that they use a lot of data to predict more or less real time what the real growth and or inflation data might look like down the road. But in the end, the key message from this one for the developed world is, yes, there is an impact, but it will be minor. Similar picture for emerging markets. However, here the figures are higher. The reason for that is they are analyzed. So if you see the change from November to December, you have to divide this figure roughly by 4. And if you divide, for instance, 1.4 by 4, you get to similar figures like in the developed world. So also here, the impact of growth in most emerging markets is visible, but it is not substantial, at least so far expected based on available data. And a very silly observation, the color of the nowcast compared to recent history is yellow. And above you see the scale. So the bluer it gets, the more it's cooling down. And obviously the more yellow it gets, the more it heats up. And it's still in the yellow range. So from that angle, qualitative statement, but still we can expect some impact or no recession. Now it comes to part, how severe might it be forward-looking? And given that South Africa is ahead of it, South Africa has had the first cases. You can see here 2 real-time data, one showing you that the mobility since the detection of the virus has not really significantly dropped. And more recent from today, the data or the chart on the right-hand side, the bars do show the cases per day. So it goes much faster up compared to the third wave, which was Delta. But now it comes the huge but. If you look at the hospitalization rate, that's the left-hand side, the first chart, you see Delta, and you see right to it, Omicron. The number of hospitalization is in absolute term lower, and don't forget, we have now already much more cases after 3 weeks than we had during the Delta wave. And the really good news is the people who die. You see again, right-hand side, the first chart, how many have died during the third wave in the first 3 weeks compared to the actual situation. And it is significantly lower. It's roughly 10 to 15% compared to what has happened last time. So the good news is the impact is minor on the health by people and on the death by people. Not shown is the impact on the people who are really in the hospital in absolute terms. There, the situation really depends on country by country, system by system. For instance, in Switzerland, we have much more cases in the hospital, much less in intensive care, but we had to implement some measures to keep that figure from rising further. So we have now mobility restrictions, and we have, for instance, home office mandatory. Nevertheless, nothing is closed. You might have to have a 2G plus regime. That means you have either a certificate as you were vaccinated or you recovered. And if in certain cases, for instance, in a bar or so, where you cannot wear a mask in a disco, as an example, you have to have on top of it a test which is valid 24 hours. But on the other hand, the rest stays open and you are free. So the impact on GDP is therefore derived from what I've shown you at the beginning and derived from this narrative, probably limited. Having said that, I do not expect for next year and for the year after a recession. And as we are going to see and talk about the outlook, you see here the S&P and its behavior during recessions. And in the meantime, what I do, however, expect is something of a real correction. So more than 10 to 20%. What we have seen over the last 3-4 trading days, this was really nothing. It was 4 to 8% in max. This was nothing. And I have seen some clients panicking. So be prepared for more. Why I'm not so concerned is also from the fixed income area. This chart is too long, so you cannot really see it, but the 10-year, 2-year spread has widened again. So it was at 74, 0.74, now it's 0.81 in the last 24 hours. And the spread 10-year 3-month is flattish and also higher compared to 3 days ago where we were at 1.37. Why is that important? Well, basically, the steepness of the yield curve gives you a hint about the expected growth and the possibility of recession. In the past, it was always the 10-year, 2-year spread. Recent studies show that the prediction power of the 10-year 3-month is much higher. Therefore, I'm pretty relaxed. The green line, which is that spread, has stopped moving down and stayed compared to the previous 4-6 weeks on very similar levels. So also from the US government bond market, there are certain signs of relief, certain signs of that the slowdown won't be as severe as you can read in the press, in the newspapers, etc. What is more worrisome, but shouldn't come as a surprise to you, is the latest CPI data. US at 6.8, highest level since 40 years. Germany 5.2%, similar highest since the 70s. And for Germany, that's a disaster because the country really wants stability. They have a history with hyperinflation. Therefore, inflation is or was for the German Bundesbank the key target rate to tackle. And at the moment, they are depending on the mercy of the ECB. And the last statement of the ECB compared to the Bank of England, which they even raised once their policy rate, or the more hawkish statement from the Fed, the ECB basically keeps in the dovish camp. They even said, on one hand, we are going to let run out the COVID bond purchasing program, but in Q2, we will restart the old program and then wind it down during the year. But they also said, we will not, most likely not cut raise rates next year. Not a surprise. And they also claimed inflation will be 3.2%, but transitory. This in itself is, compared to what they previously said, a contradiction, because 3.2% is by far much higher than 2%. And I would argue, compared to where we came from, definitely not transitory. Consequence, you do see a weaker euro. Why I believe that the next 2 to 3 data reading must be higher is due to the comparison of 1 year ago. You see this chart, I had it last time, but basically in December and January and February, the comparison level is pretty low. Therefore, a reasonable assumption is that sooner or later we might see a peak, but only lower figures will come in March. Turning back to now costs from Bloomberg, this is also from today, the picture coming from that angle, from a complete different mindset to a toolbox, if you will. You see that in all areas besides India, we do see, or we do expect, higher CPI data down the road. And I do not see any now cost which turns down or would indicate a so-called transitory behaving. Therefore, inflation is here to stay. Nothing new, said it before. The question is for how long, and that's open, because, for instance, the Fed on one hand tells us we are going most likely to see 3 rate hikes next year, 3 the year after, and maybe another 2 in 2024. But add that together and we are at 2%. I would strongly believe that in 3 years down the road, inflation in the US is most likely higher than 2%, because it used to be also in the past. But the real story then turns around, what does that all mean for us when we want to invest money? This chart shows you that it's really not unprecedented, but it is a severe situation. It is comparable to where the real return was in the 70s and at the beginning of the 80s, so during the oil shock and before Mr. Paul Volcker intervened and put the treasury rates up to almost 20%. I don't expect that to happen, but the impact is that everything which gives you a single nominal return gives you, after adjusting for inflation at the moment, and most likely, and that's the key message here, most likely over the coming years, negative real return. And junk bonds, I mean, we had it last time we were at 1.8%, if I'm rounding, and now we are at minus 1.8, and now we are minus 2.35% and falling. The next inflation data point is expected to be lower. So if I were to take equity risk, which in the end US high yield represent, then I would rather take it on the equity side. And here it comes, the update of what the market expects. So the light blue on the right-hand side tells us the futures market does not expect that the Fed will go to 2% in the next 3 years. And on the left-hand side, even worse, since last time we have spoken, the futures market for the Fed, for the 10-year Treasury yield is flattish, is almost not increasing, 1.7% at max in 3 years down the road. And even if I take the more hawkish forecast of Goldman with 2.5%, we are still in all these cases far below what I would call a possible inflation rate. I would expect inflation to be maybe around 3%, rather on the upper end than on the lower end, but definitely not on the 2% level. And here we go again. This is deliberately steered to a certain degree. It means basically that all the people who have debts, and who has the most debt in the world, all the governments, will profit from such a situation. And all the people who have to buy government bonds and quality bonds, so insurance companies, pension fund scheme, they will suffer. This is a deliberate decision. It's the only way out of this debt problem. If that is going to unfold, and I have talked about it several times in the past, that will take at least 10, probably 20 years to put debt to GDP to a recent, decent level below 100%. Having said that, that means also that you have to adapt your asset allocation, your thinking of how to diversify portfolios and assets. This brings me then to the question, shall you consider government bonds? Here shown treasuries. This is for family offices, for ultra high net individual, a theoretical assessment which you might consider for ultra high net and private banking clients. Definitely, I haven't seen any individual being invested in such kind of low yielding bonds over the last 20 plus years. But over the last 2 weeks, we had two events. We had on one hand, the Fed meeting with the press conference, where they turned hawkish, where you would have expected yields to go up. But as you can see in the circled area, yields actually went down in the 10-year Treasury, also in Europe. And then we had the Omicron appearance and yields went further down. All the assets went down across the globe. But when yields go down on government bonds, obviously government bonds have risen. So if you are willing to pay an insurance premium, / you buy a nominal low yielding assets, and in terms of euros, pounds, JPYs and Swiss francs, even negative yielding bonds, and then you subtract inflation, you are definitely in all the cases in real negative returns, but you consider that as a diversification and insurance premium to be paid, not to be invested fully in what I've shown last time, what I would call real assets, then it could be a thing you can consider. If you are, however, free, I would definitely skew the asset allocation towards real assets, including equities. Having said that, I do as well know that not everybody can have 100% in that area. So therefore, you might still be forced to invest in bonds to a certain degree. The higher the quality, the lower your starting yield. But if we were to see a sharp correction, at least part of the portfolio might be partially protected if you were to go down that route. So if you follow and believe that this inflation theme is here to stay, that the yield will stay depressed, that we have fiscal stimulus due to balance sheet recession, all themes I have been talking over recent months several times, textbook recipes will not work. I have also talked about that, but I found this example, and it's not to blame these people, it's just to illustrate, really to illustrate. So if you see, first of all, where are we? Are we in a recovery, in a boom, or in a slowdown? Well, high inflation would be slowdown. Given the macro data, I'm not so sure. given that maybe one day we will really have the end of this pandemic and we have the pent-up demand, then it's rather a recovery or a catch-up, if you will. We are probably not in a boom. So it is already hard to find the quarter you should start off. Then we have interest rates rise or fall. Well, it depends where we look at. Do we look at government bonds? They were actually falling, at least over the recent weeks, and they were not really rising the whole year. So then we are in the recession camp? Probably not. If you look at the shorter end, excluding the three of the four major central banks, the short end has seen a rise in policy rates. But again, where are we in this whole spectrum? Then also commodities. Some had a great run, some didn't, but commodity come here various times. Last but not least, high inflation cash outperforms. I am having some troubles to understand that. However, if high inflation means also short policy rates are high, then at least you could argue inflation is high, I get a high money market rate, all fine. If then cash is outperforming, I would make a question mark, but I could still say this model looks pretty good. However, we all know monetary rates are at zero, and cash holding at the moment costs you even money. Having all said all this, I could now go on for hours and hours. In the current situation, the traditional stimulus and the traditional reaction is not working. It hasn't worked since 2009. The reason for that was that the money never arrived in the real economy, because people were deleveraging their balance sheet recession. The solution to that is, if you believe Mr. Ko, a Japanese strategist and professor, is or were to implement fiscal stimulus, which was done over the last 18 months. And therefore, it shouldn't be a surprise that we have now inflation. On top of it, it shouldn't be any surprise that inflation is sticky and is not transitory. And therefore, the second theme, the steering of the yield curve control, the forced regulation to push people into low yielding assets / government bonds, high investment grade bonds. This is all a deliberate agenda and is called financial repression. Of course, nobody will ever tell you that. And if you were to listen to Mr. Powell's statement, there are two options. Either his advisors and himself really is not seeing the whole picture, which I would rather doubt a lot, or they just tell you what in their narrative makes sense and that they want us to know. And therefore, I would argue that there is a hidden agenda, and the hidden agenda in the end is to inflate away over years to come, 10 to 20, the debt to GDP problem. Having said that, don't forget, if you have inflation, and here is the example we had last time. So if the inflation is just 2% after 36 years, you have half new purchasing power. We have more than 2% in most countries. So you need to address that. And we had that already before. The only way you can protect yourself is you have to move yourself into real assets. With that, let me come to the outlook. So as you probably got it several times, I do not like at the moment bonds. So then I'm left with real assets, and one of the most liquid real assets, at least until inflation is higher than 5-6% constantly, are equities. And in December, normally investment banks play the same game every year in and out. They tell you next year is going to be a year where we are seeing 6 to 10% nominal return. Not so this year. This is the latest update for the year 22. index targets of the S&P. You see it's all over the place, and there are not too many above 5,100. Actually, there's only PMO. The same data in a different diagram basically tells you the average return is 4.2. The medium is somewhere in the 5% bracket. This is compared to normal years pretty low. My conclusion already here is I'm bullish like last year, but much less pronounced, and I do see more risk than 1 year ago, and even more obviously than 2 years ago. I do, however, expect a decent return from equities over the coming 12 months. Why so? This is an updated table from Goldman, which tells you Goldman hasn't changed his mind. So EPS for this year for the S&P 209. As a reminder, we were at 178 at the beginning of the year. So you see 47% growth this year. A similar picture from the consensus bottom up. That's the white part there. They are now at 207. Last time we have spoken, they were at 206. So analysts were definitely behind the curve and missed completely the rally. For next year, Goldman expects 8% EPS growth and 2% dividend, gives an index target of 5,100. And the bottom up consensus is now up from 221 to 224. It is similar, getting similar to Goldman's level, PE ratio somewhere between 20 and 21. That is rather expensive, but compared to the recent history, I would say there's still room for more upside. There is a huge doubt in this figure because we do not know how much pricing powers companies have, how much nominal inflation you will see on EPS. But I could imagine that next year we might see 235, or even like the bottom up says, more than 240 for 2023. If that were to happen, a big question mark, obviously, but if it were to happen, you have obviously to subtract the inflation impact. And if inflation is almost 7%, then EPS above 230 don't look so realistic any longer. But that would also mean that the nominal amount of the index to have a similar PE ratio can be higher. So therefore, if I take this chart basically to argument that if we only see next year an expansion based on dividends and earnings growth, 5,100 sounds more than reasonable to me, maybe a bit more. But if I am right and we see an impact of nominal inflation growth on EPS, we might even go further. And one key point I would like to make here, I don't know when this bubble is going to burst, but my educated guess is not next year. Why? Because you need to see a melt up. A melt up would mean that the S&P would go to 6,000 or even higher within the next 6 months and then burst. Can happen, obviously I cannot rule it out, but at the moment I don't see a catalyst for that yet. People are less bullish, people are more out of the market. Retail investor got shaken over the last weeks. We had several different mini pullbacks, and I repeat, mini pullbacks. Having said all that, I repeat myself, but we must expect in the future a real correction, and the real correction is more than 10%. It can be easily 20%. So now I would like to share with you other reasons why I am convinced that this might work. One is seasonality. Has worked until recently. Now we had the Omicron shock as we speak, or at least when I started the presentation, we had a snapback in the US as expected. Maybe, question mark, maybe we will have even a short squeeze because there are a lot of hedge funds short and they might close their books until year end and have to cover their shorts. But another reason is this one. in January, this is common sense. In January, people position themselves after the window dressing, etc. But you see, ETFs have now soon the 30th anniversary. The first one was launched in the US in 1993, if I'm correct. It was the Spider, still is one of the largest ETFs in the world. But the message here is, in January, the inflow into the ETF is 134% of the total inflow on an average year. And then you see over the year that is outflow and sometimes inflow, but the biggest move comes in January. That might move the market. Cash holding of portfolio managers. When we were below 4%, I said, I'm scared. In the meantime, we are almost at all-time high. Markets have risen and were shaken in the meantime. But now fund managers are having significantly more cash, although 4 to 5% sounds little, but history of this data tells us that now they are cautious and they are underweight equities. That is, for me, a good sign. This one is the conundrum. Money market products are almost at all-time high when we measure the global flows. Equities had a tremendous inflow. Government bonds have a steady inflow, and corporate bonds had a minor pull out of money. But the conundrum is this. And if you believe that inflation is here to stay, even if you think financial repression, I don't buy that in, but if you believe that over the next 24 months we are going to have sticky inflation above 4%, that will reduce significantly the purchasing power of all this money parked in money market. Therefore, sooner or later, this money will be invested somewhere. Can also be real estate, not shown here, real asset. It might be gold, it might be cars, old timers, you name it, but I doubt that this level will stay so high, especially given that the policy rates and the yield you can achieve in money markets will stay depressed for the foreseeable future. Another reason is chart technique. I mean, I said last time I'm missing a washout. Well, we had one. Look at this. It was yesterday and Friday. And we are down to the 200-day, to the 100-day moving average, which is the green line. Maybe it's the third time within 3 months that we will see a rebound from that level. And also this chart, obviously it's not the longest time period, but it also shows you we haven't seen in the US a pullback to the 200-day moving average, and by definition also no correction. In Europe, the situation is different. There we have seen correction to the 200-day moving average, in some indices even below that. But the key message here is the leading stock market of the world had seen a washout and is only down to the 100-day average. That sounds pretty promising. Now let me say something about what people and I are concerned of. Runaway inflation is one thing, but then to be at the same time scared about tapering and policy mistakes, it's a bit contradicting, because runaway inflation must be beaten with measurements on to restrict the money and the rates go up. Nevertheless, the policy mistakes is here a huge risk, and I don't know how it will, for instance, end in Europe, but when I listen to Madame Lagarde, I must say, a nice speech if I were a politician, but she is not in a function of a politician speaking to us. She speaks as somebody who has to follow the regulation the European market has given to the ECB. And I am not buying in that inflation is transitory. I am scared that they want to buy more bonds. I am also surprised that they, at the moment at least, do not see any need to raise rates. While in Great Britain, which we can argue if it's Europe or not, but just in front of Europe, if you will, they admit we must fight against this inflation, and to a certain degree, also against the recovery or the possibility of a too strong recovery. And that's exactly the problem. Due to Omicron and maybe also due to later in the cycle, we do see a slowdown and you start raising rates. So policy mistake is definitely something I'm scared of. And Mr. Powell, who is not an economist, who is a lawyer, has explained pretty well what the Fed is going to do and convincingly told us a narrative how they see the future and how they will manage to go through that. And between the lines, a lot of Fed watchers even think they still believe in the narrative of transitory, because it can well be that in March, April, May, inflation comes sharply down due to the statistic base effect and due to the actual decrease of growth of the fifth wave, and that they might not raise as much rates as they told us. China is for sure a problem, geopolitics. I mean, I'm not going to comment on politics, but there are a lot of areas in the world where there are conflicts. And last but not least, the pandemic situation is of concerns of people. I just would add, we have learned to deal with it, and the impact as shown in the beginning is probably minor. If I were a restaurant owner, a cinema owner, maybe a bar, a disco, so all areas where I will or would be affected by these measures which are taken, obviously the assessment is different. But if I'm coming from quoted stocks, from things which are traded at the exchanges, the conclusion we had some months ago about Delta are still valid. The impact on quoted stocks is limited. That's at least my strong belief. This is definitely an area of concern. So here you see most emerging markets and what they did this year with rate hikes. And you can see, let's start with the positive one. India was a great market this year, one of the best performing markets in the world. What did they do? Well, they didn't raise rates. They also have no inflation problem, and they also have no financial repression problem. On the flip side, you see Brazil and Russia and Chile. And then you look at the stock market. Not shown here is the Bank of England. First of all, it's not an emerging market, and second, it had just happened recently. But that's the next point. Next year, also developed world will catch up to the emerging markets in terms of the medium policy stance is hiking and not decreasing rates. So that is definitely a certain concern. Coming from the US, where we have more history, where we have more data, you remember maybe, and a huge question mark, maybe 2% policy rate in 3 years, and maybe 2.6% in 10-year treasuries. Equity markets can cope with that, in particular when the Fed guides us there. So therefore, I'm not really concerned or scared from that angle. I'm a bit scared that if this were to happen, that the curve will be flat. And the flat curve obviously is an indication that forward-looking, there is a slowdown in growth. So it is definitely a tricky one here, and therefore I would use the phrase a lot of people always use, next year will be a bumpy road, but on average equity go up. This is basically to say we all don't know. Nevertheless, I hardly ever use this phrase. I really believe that equities go up, but it must have some loopholes and sometimes surprises on the front of the policy stand. There's also hope, because China has just recently cut again the reserve rate for banks, that they lend more. They have loosened their criteria to lend to property companies. So there's a certain amount of hope that from that area we will see support, and maybe question mark, maybe they will also have support from the fiscal side, which would be more effective. China has on top of it the Olympic Games next year. They want to show themselves in the best light. So I believe they will try everything to keep the economy growing. Of course, when we talk of China, we also have to talk of the credit spread, the problem in the construction area, and what it meant or still means for high yield bonds. You can see compared to last time, spreads have significantly in the terms of absolute amount, but from where we came from, not so significantly tightened. They are still at extreme high levels, but we could also turn it around and say, at least it didn't get worse. We had some defaults in the meantime, it didn't get worse. Maybe it stabilizes on that level, but that's definitely a concern, and that might rattle the market from time to time, as it has already. Interesting is I still see in the global high yield market, excluding Asia, almost no spread widening. I have put there in a smaller box the levels we have seen last time we spoke and where we are now. I mean, it's roughly 12 pips. But given to 1 month plus ago and now, it is probably fair to assess the world is more uncertain, the growth outlook is more uncertain and more shaky than it was, and still you do not see it on average in most global corporate bonds. That's amazing, but at the same time it's a risk. As you can see, during the Omicron sell-off, the spreads widen significantly. Something like this can happen anytime. It probably will happen together with the burst of the equity bubble. And that's the question, when does that happen? Nobody can know. My assessment is, as long as we do not see signs of a melt up, extreme steep curves in indices, I don't see that. By the contrary, I mean, 95 of 100 Nasdaq stocks have over the last 6 months significantly decreased, although the index is slightly below its record level. Recently, it was even at record level. So you can even argue we had this year a market correction under the index level, which is a bit weird because index, also the S&P, is almost at all-time high, while at the same time, a lot of constituents have seen sharp declines in prices. Forward-looking, obviously, copper has had now a really, really long period of consolidation with some hiccups to the upside. Midterm, if this green revolution is going to take place midterm, I would argue that copper must go higher, and I would consider that in my asset allocation. Similar picture, I had that last time, so I will be brief. 86% of global electricity production is done with oil, gas, and coal, and only 4% with nuclear. Having said that, roughly 10% is done with wind, solar, and other alternatives. If we really want to solve the problem of the carbon emission in this world, we really must consider nuclear power station. People in the sector expect that we are going to see a doubling of the demand for uranium over the next 24 months. If that were to happen, obviously the uranium spot price will significantly go up. It's around 45 at the moment. It came down from 130 12 years ago. So just do the math. If that doubles, the mining stock will double at least, probably even go up higher. It is also a real asset, if you will, and it might be part of the solution. Oil is very tricky to invest. There is still an upward trend. It is unfortunately no contango. There is one thing we should not forget: the lack of investment into new oil fields, into rigs, if you will. That brings the oil companies in a position where they pay out a lot of dividends, share buybacks, and do not invest. That has two effects. Maybe if you are ESG agnostic, which is hard to beat nowadays, but let's assume you can invest in that area, you have a natural support because there is not enough supply, but the demand will not so fast shrink like the production, because if you do not invest into your production area capacity, that will have an impact on the supply. Gold is a real asset. We had that several times, and I must repeat myself, I don't see at the moment a catalyst for it. We have a stronger dollar, we have lower yields, so one is positive, one is negative, but bottom line overall, still we are hovering around. If inflation is here to stay, I expect that gold will serve you well. That means it protects your purchasing power, no more, no less. Therefore, I would not dump gold. The dollar had recently some hiccups, but the trend is still up. And given the hawkish tone in the Fed, given the positive growth outlook for US economy, I would argue that this this dollar index will further go up, and especially against the Europe, as long as the difference in the two policies is so big, I don't see why the euro should strengthen. Of course, there is always counter rallies, but on average, I would at the moment not bet against the dollar. Bitcoin had a rough run. I would basically not own it for one simple reason. I cannot evaluate it, and there is no history. But I also admit there is a lot of demand. In the case of Bitcoin, which is not the best performing crypto this year, but in terms of the Bitcoin, there is a limited supply. So it can well be that we will see the 125 over the next 12 months. But honestly, I have no clue, and I don't know how to evaluate that. With that, let me come to the conclusion. I mean, bullish, but with a lot of headaches. So my take is that climbing the wall of worry is the most likely outcome. We see a temporary slowdown now. The ECB and the Fed are probably behind the curve because one doesn't want to raise rate at all, and the Fed admitted openly, on one hand, they should have cut the bond purchasing program before and much faster, and then for the question, why do you not do that, and especially why do you not raise rates? The answer of Mr. Powell was astonishing. He said, we do not want to upset the stock market. And for those who were following the press conference speech, this was amazing how the S&P turned within minutes from flattish, slightly negative to a very strong day. That's all said, but this is a deliberate decision. Inflation is here to stay, so is negative real yields. Bonds is a tricky issue if you consider corporates, but after inflation, you will lose money there. Similar thing to cash. Government bonds can serve you as an insurance, but in absolute term and in real terms, most of the time you will not make money. Similar picture for high quality bonds. The equity area and real assets are of preference for us. In terms of valuation, Europe is cheap, but have you seen the correction over the last 3 days? Europe was once more at the forefront, while the US was mildly correcting, and the growth outlook for the US is definitely better. Asia is extremely cheap. It will be interesting to see if after Christmas we will see a buying of the fallen angels, so the Alibabas, JD.coms, etc. of this world, and a snapback next year. That is possible. What speaks against is the rate hiking cycle in emerging market, but at the same time, it can be expected that China will loosen further its monetary policy. We like cyclical and small caps. Chip producers, they had a rough ride, but on average, they're still sharply up. Real asset means commodities. Mining is an area, energy is an area. Industrial metals is when there is a reopening going up, but also there it's hard to find the right place because Sometimes aluminium goes up, sometimes iron ore, but hardly ever they go up in tandem. Similar picture with copper. REITs and gold are real assets. REITs, I really urge you go for things which are residential and or have contracts in the background which are inflation adjusted. And I'm sorry to be repetitive, but the investment strategy hasn't really changed, and all assets are expensive. And we haven't had a correction, and be prepared for one. Last but not least, I invite you all, if you want to hear more on a regular basis. The last 3 days were pretty busy given the various moves in the market. You can follow us on Telegram. With that, thanks a lot for your attention, and let's open it up for questions.
Andreas, yeah, thanks a lot for the presentation. Yeah, the participants, please submit their questions. We have one from one of our regular participants. I think you've sort of touched on this during your presentation. It's about the allocation of cash that is currently some of cash was taken out of risky assets. And the question is, do you expect this extra cash to be moved back to risky assets or to reallocate it somewhere else?
I wish I knew. But I mean, I would expect that part of it will be reallocated, maybe in the real economy. I mean, I see a lot of demand for real estate, be it to rent, to let, or be it for yourself. This pandemic has moved people out of cities, so there's a lot of demand to buy a second place to be and to work from there. I see a lot of astonishing auctions in art, maybe not for everybody, by all means no expert, but some money is moving there. And I would expect some still to be deployed into equities, because as the question here rightly spotted, we have seen some outflows of risky assets, which is now parked. If we were to see a short squeeze like Kolonovich, a strategist, a US strategist, quant strategist foresees, money will come back. If not, money comes back seasonality, as I've shown in January. But I would also add that most likely this, let's call it conundrum high cash allocation, will not completely vanish. Because cash has one advantage, unless your place where you hold it goes bankrupt. But otherwise, if you have 100, you still have 100 in 1 year's time. Maybe it doesn't buy you the same thing, but you will not lose money with it in nominal terms.
Yeah, thank you. Yeah, if there are any questions, please just raise your hand. We will, you can ask it by voice as well. I'll then ask my own question that's about the Russian market, because naturally most of the participants are from the Russian market, and it's a natural tendency to have a larger exposure to the local market than to international markets. That's a natural skew, but this year Russian market has performed relatively well, up like 10% compared to emerging markets, which were down on average, despite the latest sell-off. There are quite good differentiator for the Russian market, which is a high dividend yield, about 10% dividend yield, compared to like emerging markets on average, maybe 3 to 5%, S&P 1 at most 2% average dividend yield. So what's your take on the prospects of is there a good like investment proposition from the Russian market compared to other emerging markets, like compared to China, for example, for international investors? What do you think?
Some of the good arguments you have already made. So you have a dividend yield which is pretty high. you are not, you know that better than I do, but you are not simply depending on commodities. There are other things. What you haven't said is that the Schiller P is one of the lowest in the world, so there is value there. We had a tremendous run until October, and then a certain sell-off. There are probably two reasons for that. One is oil itself, and the other one, which I'm only saying the word, I'm not going into details, but the other one is political tensions between your country and the Western world. There's also the problem with Nord Stream 2. But to cut a long story short, if I am going to invest globally into equities, I would, compared to an MSCI World, definitely over-allocate Russia. And I would, within an emerging market complex, over-allocate Russia. Also India, because India doesn't have financial repression problems. I would tactically bet for China, although it hasn't worked this year. And although I'm a fan of Vietnam, I would probably take out some profit from there, because we had 50% this year, and it's not so likely that it's going to repeat. So overall, I think it makes sense to hold Russian equities. Obviously, I'm talking as a foreigner or an international investor, if you will. But the reasons you mentioned are really compelling. So if you look for dividend yield, if you look for cheap assets, you have already two main reasons why you should consider to allocate some in emerging markets. And especially if you do in the old context of BRICS, I mean, I would prefer definitely Russia over Brazil. And I would probably prefer Russia over China, although it's a tough call. And only India has probably more sound fundamentals.
Yeah, would agree. Yeah, we don't have other questions from the audience. Maybe I'll ask one more on a different topic. I came recently across an interesting article from PwC. They did a survey regarding among number of asset managers, several hundred asset managers, regarding the how they basically about the economic realities of ESG and ESG investing, this environmental social governance topic. And what they found is, in general, when they invest, when asset managers are asked by a simple question whether they implement investing, when they do investment decisions, whether they consider ESG, then 80% said, of course, yeah, we do. But then the next question was, how much haircuts in investment returns would you consider fair if you would, and you would, what decrease in investment returns you would consider if there will be some social or environmental benefits. And 80% said that less than 1%. So they are prepared to do anything, but they're not prepared to lose more than 1%, which sounds not too much for me. So is there in your view, do you think we will be moving in the direction that investors will be prepared to lose more than 1%, or it's more or less they will be still the majority of investors are not prepared to lose anything?
I mean, you really framed it extremely well. If I ask you, you want to be healthy, whatever, you will always say yes. But when it comes with the price tag, there it's where the truth of the pudding is. And I am not sure that a majority of investors are willing to sacrifice significant return just to be in bracket ESG compliant. And let me rephrase it. What on earth does that mean? I mean, if you have an MSCI World ESG index and you have all sector represented there, maybe you exclude some extremely obvious things like, for instance, weapon, maybe tobacco, maybe alcohol, question mark. But nevertheless, you have all the other sectors and then you only exclude the weakest of the weakest, but then you still own the rest. And then I must ask you, is this ESG, question mark? In the old time, it was called sustainability. I mean, we have a great example here in terms of cement production, which is Holcim, so one of the world leaders in the world. They do everything you can, but they will always be a producer of cement. And for cement, as we all know, you have to use coal, you have to emission a lot of CO2, etc., etc. This example goes so far that they are punished, the return is low. But there are other examples where I ask myself, how can this company be ESG compliant? And the answer then is, well, if I compare A to B and C, A is by far better than B and C. Great. I would call that greenwashing and not ESG, but that's a labeling thing. But the shortcut is, I don't think that if the price for ESG is lower return, that people are willing to accept it over the long term. Having said that, it is hard to find new products or name changes of product which are not ESG compliant. So somehow in 5 years down the road, everything you buy is somehow with a label. So therefore, you will come across, but I don't think the economic reality will be that all this stuff which is then in this product is really clean and green. I have met one manager, which I would say they are extremely coming from the green angle, maybe even from the left wing, who knows, but they invest globally only in companies which they believe are in their field leading. But this is an exception to the rule, has a great performance on the top, but on average, it cannot be that all the products, all the things you buy is ESG compliant. And also the funny thing is with bonds, you buy a bond from electrical producer, which has a tiny part in nuclear power station. They issue, and the rest is, for instance, coal, and maybe some is solar. But some tranches of that bond are used in particular for the green stuff. Great. But the rest of the company is still what it used to be. So why on earth is one bond green? Of course, I understand how they do it technically, but still, and the rest, which in the end, the rest is the substance for my bond that they pay my coupon and repay me my money. The rest is still where it used to be. I do not buy that in, although I know that it's a green bond and I understand. And I had recently a case of a client which forced us to sell a green bond of an electrical producer because, and now it comes to the hilarious part, because he had 4% of his revenue still in nuclear power station, which I would consider a better solution than oil and gas. But on that angle, because of that tiny bit, the ESG aspect forced us to do something which I would consider not compliant with ESG, or the opposite around. Exactly that bit he was claiming for me is the cleaner part than the rest of it. So it gets really tricky and to a certain degree ridiculous. We have, for instance, an equity manager who does mean variance optimization based on an ESG, MSCI Switzerland, and also for other areas. And he claims that his return based on models is even better when he uses that. Reality shows that's true for the main product, but not for the rest. So I see here a lot of labeling, not to use greenwashing again. And I don't think, I mean, do the math. If you lose 1% for 10, 20, 30 years, do the math how much money you will lose over the long term. And I'm not so sure if down the road this is acceptable once people do that math.
Yeah, indeed. Yeah. let's hope the world will figure out how to economically incentivize the move to greener world. Yeah, I think at this time there are no further questions. We will finalize our webinar today. Thanks a lot for the presentation. Wish you and all the participants Merry Christmas and Happy New Year, which is kind of the key holidays for the year. And yeah, have a great end of the year and the next year as well.
Thank you. Same to you, to all participants, and enjoy your later Christmas than we have, and see you probably much later in January or February. And
see you.
If markets do what I hope they do, or if I'm completely wrong. Thanks a lot.
Thank you.